Are you struggling to increase your trade outcomes with IDR? What if I told you there are 7 steps that can transform the way you frame your trades before executing them? Let's get into it. Step 1. Identify the DR model. Before considering any trade, the first step is to identify the DR model price is currently in. Why? Because this gives you a clear picture of the overall market structure and where price is located. In this example, the overnight DR opened right at the middle of the aftermarket defining range and pushed higher, leaving the aftermarket lows intact. This hints at a possible DR upside model forming. Already, we're starting to build the case for a potential long setup. Step 2 is crucial yet simple. Identify the color of the DR box. A green DR box forms when the closing price is higher than the opening price, signaling potential upside and increasing the probability of seeing a long confirmation. On the other hand, a red DR box forms when the closing price is lower than the opening price, hinting at potential downside and a short confirmation. In rare cases, you might see a gray DR box where the opening and closing price are equal. In this example, the overnight DR box is green. Additionally, the aftermarket DR session also closed with a green box, further supporting the likelihood of a DR upside model. We are already stacking probabilities in our favor by aligning the DR model with the box color. Step 3. Mark out volume and gap imbalances. Step 3 is to check for volume and gap imbalances that align with the current defining range. These levels can support a trade idea and help anticipate retracements or act as barriers for price. First, we have a daily gap imbalance created before the aftermarket DR session, which could influence price action if revisited. Next, we highlight intraday gap imbalances. This intraday gap imbalance from the aftermarket DR session sits just above the overnight DR session lows and could act as a barrier to prevent the DR upside model from breaking down. I repeated this quite often now. The aftermarket DR session gap imbalances are very important and should always be marked out on your chart. Lastly, we highlight previous volume imbalances inside the defining range, as they're helpful for identifying high probability areas where price might retrace. In case they are too many, you can always toggle them on and off when needed. If you want to learn more about how volume and gap imbalances work, check out my free video that dives deeper into this concept. It's knowledge every trader should have. Step 4. Highlight previous DR session levels. Step 4 is to mark out previous DR session levels from this day, previous days, or even the previous week. Why? Because these levels are important for market algorithms, and if you study them, you'll gain great insights into how powerful they are and how they influence future price action. In this example, we highlight one level from the aftermarket DR session, another from the previous day's regular DR session, and one from previous week's price action that aligns with the current overnight DR session. These levels will support our decision making. Now that you're ready for any scenario, whether a long or short confirmation, you can toggle these levels on and off as needed to keep your chart clean and focused. Step 5. Wait for a confirmation into either direction. Now the critical part, waiting for a confirmation. This ensures a higher probability of seeing price continue in the confirmed direction for the rest of the DR session. In this example, we've already increased the probability of getting a long confirmation. Why? Because the DR model hints at a possible DR upside model forming, and we have a green DR box already. These factors stack in favor of a long confirmation. Half an hour after the defining range formed, the 4:30 a.m. candle closes above the DR high, giving us the long confirmation we were waiting for. With our preparation complete, we now shift focus to execution. Step 6. Wait for a retracement into the defining range. Step 6 is to wait for a retracement into high probability areas with clear rejections inside the defining range. In this session, price reaches the 1 standard deviation level, but 2 open volume imbalances within the range hint at a potential retracement back. Price retraces, rebalances the upper open volume imbalance, rejects the previous DR session level, closing price, and whips. And this is where we come to the final step, executing a trade. This setup offers a potential 4R trade with the stop covering the mid-level. Unfortunately, this first trade results in a loss as price retraces deeper into the range. Price rejects the IDR mid with a double volume imbalance. This is your second bullet for the session, which offers a potential 4.5R trade targeting the next standard deviation level with stops at the retirement setup area. As the session ends, you're either stopped out break even or leave the position open, since there is no indication yet of the DR upside model being broken. Later in the regular DR session, a new opportunity presents itself. Price retraces to a stacked confluence area with double previous DR levels, volume imbalances, and the DR upside model still intact. Notice how the overnight DR session high and the daily gap imbalance also support the idea of continuing the DR upside model. The minimum target to fulfill the DR upside model here should be the ODR session highs, and ideally the original target, which lines up with the 1.5 standard deviation level as well. This trade offers an 8R potential, presenting you the power of where preparation meets great opportunities. We had one trade in the overnight DR session that resulted in a loss, while the second one could have been either a break-even trade or a plus 4.5R, depending on your risk management. Later in the regular DR session, all confluences for a DR upside model remained intact, and price presented a very high probability trade with the potential for an 8R profit. In total, that's a plus 11.5R, with all trades supported by multiple confluences and absolutely worth taking. Let's summarize the 7 powerful steps for better trade outcomes with DR IDR. 1. Identify the DR model to understand market structure and where price is located. 2. Check the DR box color to assess directional bias before a confirmation. 3. Mark volume and gap imbalances to anticipate key price areas. 4. Highlight previous DR levels to add strong confluence. 5. Wait for a confirmation to increase probabilities. 6. Wait for retracements into high probability areas. And 7. Execute your trade with a clear plan. When you combine these steps with discipline, you're setting yourself up for higher probability trades. And remember, if these steps don't align or fail to give you a clear picture of the current price action, it's better to skip the session and avoid trading in lower probability conditions. Master these steps and watch your trading results transform. They're simple to apply to your charts and absolutely worth backtesting. You'll be amazed by the insights they provide over time. If you found this helpful, like the video and let me know your favorite step in the comments, and I hope to see you in the next video.
We're gonna take on the world.